Cheers, everyone, and welcome to Iterator. My name is Richard and I'm here with Shaurya, and today we're going to talk about how an investor evaluates early stage ventures. How are you doing, Shaurya?
I'm doing pretty good, Richard. How about you?
I'm doing great. I'm doing great. What have you got on your mind today?
Yeah, so evaluating startups. So I worked in private equity prior, and I have experience with venture capital as well. Even though the stages are very different, the underlying thesis or underlying process to vet startups before you even go for further due diligence, it's more or less the same, with a few tweaks in the private equity space because they have the luxury of data, whereas early stage venture capital, they don't. So yeah, there's a lot of things to cover. So I guess we can dive right into it.
Sounds good.
Okay. So when we look at early stage startups as an investor, there's like a lot of things we look at, but the primary buckets we can put the criteria in is like the team, the technology, the traction, the market, financing, competition, exit, and valuation. Because as an investor, you care about how much money you're going to get once you are done investing, and you invested in the company for like 5 years or 7 years, depending on the fund lifetime. So yeah, I guess we can start with the teams. So Richard, since you've worked in a venture builder as well, what's your take on the teams? Like when you look at a startup team, if you were an investor, or since you also look at like venture destroying activities, so when you look at the team, what are the things or the red flags or the green flags you look at?
Yeah, I think that in terms of teams, something that I found is very beneficial is just knowing that they've been put through the pace. So if they've had experience in the space, if they've done something similar before, if they've got some unique insight into that field, that's great. And also it does help if it's not their first rodeo together. I mean, for two founders that just met and they want to start a venture, not saying it can't work, but it's much more reassuring and easier to see that they've known each other beforehand. They already developed a good working relationship. It inspires more confidence in me when I see that.
Yeah, it's pretty similar. Like my list would be similar as well. Like also another thing I'd add in is their dedication. Are they doing this full time or part time? Because circling back to the first episode with Margaret, we discussed like lifestyle entrepreneur versus hardcore entrepreneurs. Because as an investor, you want to invest in a team, especially in early stage. You're literally investing in the people more than the idea. So you need to know their dedication and what are the qualifications. Do they have previous exposure? Are they living the problem they're solving, or did they live it in the past jobs? And strong collaboration. How's the team dynamics like, as you just mentioned? Like even if two people met in the same space and they've faced similar set of problems, it can actually work out better than people you've known from the past, because you can be biased in terms of the qualities or qualifications of the team. So yeah, I guess that's a pretty comprehensive bucket for team. I think next we can move on to is the technology. So I'll probably take the lead for this one. Especially in early stages, there's like a few sectors or industries where intellectual properties or rights or ownerships of specific technology matters a lot. That's especially in the health tech space. You have to go through FDA approval. You need to have patents in order. But sometimes, especially in the SaaS space models or like more consumer focused products, it's more about differentiation rather than the IP. How is their service or how is the technology different from the existing solutions? Is there a product market fit? Does it even exist? Because in some cases, product market fit simply doesn't exist in a particular niche market. There's an interesting term in my fund. We say, is it a vitamin or is it a painkiller? A vitamin is a nice to have. A painkiller means it solves a problem that multiple people are facing, and they will be willing to pay the money to get the problem solved.
So finding like a deep enough pain that people are going to be scrambling to kind of like get their hands on the product or that service. Yeah, that makes sense.
Yeah. What would be your take on it?
It's quite interesting that you mentioned different industries as well. I pretty much agree naturally. I know that in terms of specific technologies. When I did a short stint at a medical devices startup, I noticed that the solution that they were developing, it was specific for the African market. It had unique applications. It was different from other things being done in the market, and it was quite particular. It's quite incisive. And looking at that from an outsider's point of view now, I do see that there's definitely value in that. There weren't an also ran kind of situation, and they were competing with big companies such as, well, the names escape me, but it's in terms of artificial heart valves. And you look at kind of like the technologies used to create them, the delivery method and all of that, and you could see that they had something special going on there. And that's in sharp contrast to other areas in which, let's say, for example, if someone is making, well, most people are making an app nowadays, for better or for worse. But underlying that, there needs to be a solid business model in which they tackle a proper pain point, realistic one. So I agree for sure.
Yeah, totally. And moving on to the next section was, I think, markets. So markets, especially in the early stage VC space, investors are more comfortable if they see that the total addressable market is around $1 billion. That is like the set standard, because investors want returns, and if they see that the total addressable market is big enough, they are comfortable that they can obtain at least like 1 or 5% or even 10% of the entire market and get decent returns, especially at the early stages. You're talking about pre revenue, or even sometimes bootstrap startups who have decent amount of revenue or financials. So you need to have like at least $1 billion in the total addressable market, and also not just the market size, but how fast is the market growing? Because with upcoming trends or income trends, sometimes there are a few markets that were stagnant for the past 5-6 years, and then suddenly there's a breakthrough in the tech, and there's a huge demand, a huge problem has been solved by a company in terms of the solutions, and then people can apply those solutions in the startup context and make more money out of it. So how fast is the market growing? And also the customers within the market, like, who are they? Like, has the entrepreneur or the startup figured out who is their target customer? Because that's pretty important when it comes to marketing or even developing the product itself. Like, are we addressing tech savvy customers? Or are we talking about people who are not really interested in what's going behind the curtains and they just want a solution? How much autonomy they want in the product, etc.
Sure, I definitely agree. When you mentioned the growth of markets, it actually reminds me of the acceleration that we had now because of the coronavirus. Because if we're looking at everything now, back then, you'd see some sectors, kind of like decreasing or slowing down, say travel and hospitality. But others, like, let's say, for example, technology companies, food delivery services and all of that, just increasingly growing just because of the nature of people staying more at home. So it's thinking about that and knowing that those trends are essentially an acceleration and not just a blip that's going to come back down to pre-pandemic levels, but something that's going to change in terms of our behavior, and plotting that out. I think it would be super useful for investors to know kind of like how those macro effects can affect change in those industries. Absolutely.
I mean, investors are always abreast with what's happening in the space, in terms of what's in demand, what's not in demand anymore, because essentially it's these trends that runs the entire market and the valuation, right? Ultimately, it's the demand and how much are people willing to pay for a certain solution or product that drives the valuation ultimately. And going beautifully tying to that would be our next bucket, traction. Traction, what is the progress of the startup up to date, right? Are we talking about a bootstrapped startup that has like 500,000-600,000 USD revenue? It can also be a literal startup idea that a person came up with a month ago. They've been validating it, and people are saying that, sign me up for the beta, I'm willing to pay. What is the nature of the contracts, or what would be the potential recurring revenue, and what is the stage the startup is in? Because as I said, it can be bootstrap, it can be just in the ideation phase, it can be pre-revenue, it can be post-revenue. So there's a lot of factors in the traction. I agree. And now that you mentioned kind of like the different measures that people use to kind of keep track of traction,
it makes me think of evidence strength again. I feel like so many roads come back to that. So for example, what people do is much more, it weighs much more heavily into what people say. So if I say, yes, I would definitely use that product. I've heard that quite a few times, and it doesn't always pan out for one reason or another. I like to think that people are just busy. But you have a whole spectrum of things in terms of someone says that they'll use it, or they say, okay, I will sign up to use it when it's available. So they drop in an email. That's a little bit more, that's actually an action. So it's a little bit more valuable. And all the way down to people actually paying for it without seeing it. That is a very strong signal. It means that their pain is so intense that the painkiller that they're hoping to use, even if they don't fully grasp it, because they know, presumably they'll know what kind of features it will have, but they haven't used it yet. They don't fully grasp it. They're willing to put down money to kind of see that through. So I definitely agree there in terms of traction.
Yeah. So something you just said, it remind me of a thing my professor of sales told us. In sales, there's 3 responses you can get: a yes, no, and a maybe. And maybe is the worst response someone can get. Because yes means you've closed the deal, no means you've closed the deal, but not in a favorable way. But maybe means there's a lingering thought that, oh, this can be a lead, this cannot be a lead. And no matter how much time you put in, there's uncertainty in the output. And yeah, as you said, if the problem or the pain is big enough that people are willing to pay or sign up for the service, I think, yeah, that shows that that's market validation in itself. Like if sufficient amount of people are ready to pay for it.
Yeah, exactly.
Yeah, coming to market validation, another factor that many startups overlook or try to undersell to investors, which I've personally seen from a lot of decks, is competitions. So again, I've seen numerous startups in the pitch decks mention, oh, we're the first startup in the space, which is not the case. Usually that's not the case. And then they come up with when I confront them or any other investor or people in my team, they confront them with that, like, there's a similar startup like yours, then say, oh, they're different from us. So another factor is the differentiation. Like, how different is the competitor? What criteria the startup is using to discard them or include them as a competitor in the same space? What are the comparable offerings for the same? And what are the current, substitutes for your startup idea? Is there like a Microsoft or a Google service which is already doing the thing you're doing, but people don't know about it anyways? So those kind of things. And then threat, even like, who are the players? Who are the major threats in the space? Is it a red ocean? Is it a blue ocean? That kind of a thing. So
definitely. Now you mentioned being the only startup doing something. I find that interesting because it's exactly as you said. Usually many people they converge onto similar problems and they try to hack their way at them. I mean, for example, and looking back at the previous tech wars of old is always an interesting thing. First of all, because you almost never recognize the names, right? Because tech moves just so fast. But when I think about Google, Google was not the first search engine, not by a mile. I actually don't know the actual number. Were they 9th or 27th or something like that? They had quite a few before. And yet they still managed to eat Alta Vista's lunch. I think Alta Vista was the leading one at the time. Of course, the reasons for that we could dive into afterwards. But long story short, I think that they were very well positioned in terms of their technology and the team. When I think of an investor evaluating a startup in that sense, the main thing that comes to mind is if they think, okay, I'm looking at this team right now. Do they have what it takes to be the winning team? Because if I invest in them, it precludes me from investing in everyone else. I am betting on them and consciously choosing to not bet on all of the other teams. And that's what comes to mind in that sense.
Yeah, absolutely. I mean, personal opinion, but I think that first mover advantage can be disadvantageous for many situations and many industries, especially in the tech space, because let's say a company comes up with a brilliant idea, they get traction, they get a lot of buzz around them. There's time for competitors to analyze what they're doing right and wrong and see what's like the most common complaints. Look at the feedback that people are providing it online, because everything's happening online now, right? and people basically suggesting features or requesting a lot of features. If your rivals beat you to it, come up with a better user interface, with a better user experience, with better servers, you can literally capture the market, even though you're like the fourth or fifth entrant in the space, just because you're better than everyone else. So again, it's about iterations of different.
Exactly.
So
And
yeah.
a final note on that as well is that when I tend to see news like that, so let's say, for example, entrant number one is on the news because they've got this spanking new product. Usually what you see on the news is 2 or 3 steps behind of what they're actually working on. And so for new entrants in the market, you'd presume that they're also behind, right? But a very, very pernicious issue can arise when all of that publicity can actually bog down entrant number one, because now they're getting a lot of requests, let's say, for example, and they're dealing with scalability issues. And they're getting so much feedback driven because of that marketing now, that they're trying to address all of that without a singular focus in terms of vision and incorporating that. And so that could actually mean that their own progress slows down. And if the competitors are hungry enough, and usually they are, that's when issues can start to appear in terms of their prospects. Yeah, I agree.
Oh yeah, true that. So moving on to the next aspect would be financing, like how much the team wants at what valuation, because let's be frank, valuations have been out of whack for the past few years because there's way too much money in the VC space. There's more money than more startups right now, realistically speaking, and venture capital firms, they want to deploy the money. So they are willing to inflate the valuations. So the entrepreneurs should be aware of what the like similar startups or in similar stages are getting, and what is the use of funds. Like, what are you going to use the money for? Because that's a prime slide for me, especially in a slide deck, because that shows that how well thought their entire roadmap is, and how much they're planning on, deploying capital for marketing versus developing technologies, etc. It just shows that is the entrepreneur or the startup mature enough to receive funding and use it responsibly.
I agree. I know that in terms of valuations, I like to think of it as a when you think of a supply and a demand kind of dynamic. Of course, it's up to the viewer's interpretation of who is the supplier and who is providing the demand in terms of startups and venture capital. But there's definitely a surplus of money floating around due to a combination of many effects. Like, for example, low interest rates, just a keen interest from institutional investors, kind of take a little bit more risk in terms of their portfolio, just allotting a little bit more to the venture capital pie, whatever it might be. If there's a surplus of money, it means that money is trying to find a home. And so it's much simpler for founders to get funding, even though it's no easy task. I'm definitely not saying that. But I also heard that raising capital is one of the easiest things that a founder can do. And if it's already difficult, then you can benchmark for the other things. But when the situation turns, perhaps, then the balance of power kind of shifts to the investors again. And also, I think it's another conversation on whether that's going to be happening anytime soon. I'm pretty sure that we could speculate, but predicting the future is hard, so I hear. But yeah, those are my thoughts on that.
No, absolutely agree with you. And yeah, I guess we can move on to the next one. That's like exit and the valuation returns. So exit. So while speaking with founders, we, especially in early stage, we want to know what options they've considered for an exit. That can be an IPO, an acquisition, it can be like a secondary investment, and we can understand what would be like the potential acquirer for the startup. Like, that shows that the company has done its market research. They know who their competitors are or collaborators are, which of their major clients can acquire them potentially if they're benefiting so much. It shows maturity again, and also knowledge of the entire space as to how well structured the management is and how open they are to such an exit. Because there's like if there's like a rebellion or there's opposition within the team for a particular exit, it can cause a lot of problems, especially for the investors, because it can delay the entire exit, right? And then also the exit valuation, for as an investor, you care about your valuation or returns, how much you're getting, right? So how much revenue growth is expected by the end of life. For example, like let's say I invest in a startup for 5 years. What is the revenue growth I see over 5 years? What is the exit multiple we're looking at? How much cash they're going to generate? Is there any future rounds they're planning on raising, for example, in year 2? How will that affect my equity? There's a term called dilution, right? What is the IRR? What is the MOIC? Those kind of things. I mean, we can jump into the jargons in another episode, but yeah, investors care about how much returns they're planning on getting or how much they can get, and they want to know the projections of the entrepreneur, like this is our revenue growth year on year or over a 5-year horizon, so they can calculate the returns. The investors can calculate the returns.
Of course. I know that in terms of either going for IPO or perhaps selling to another company, there's definitely a discussion there about founders that are missionaries versus founders who are mercenaries, for another episode perhaps. But in terms of returns, I think that many people tend to overlook that the investors have got investors of their own that they need to return to. So let's say a venture capital firm may be dependent on institutional investors who say, hey, we're going to invest in your fund. That fund is going to have, let's say, a lifetime or life cycle of 5 to 10 years or something like that. And at the end of that time, their investors are hoping to see returns as well. And so VCs are in the middle and they have to manage those relationships. So it is not trivial to actually worry. Of course, hopefully not too much. They're also focusing on solving real problems, or at least enabling the solving of those real problems. But it's something that they have to keep in mind as well.
No, absolutely. I mean, I guess it's a pretty comprehensive list for our audience for this episode of podcast. So I guess we can wrap up for today. What do you think?
Fantastic. I'm happy with that. Thanks, Shaurya. Yeah, it's been an interesting discussion for all our listeners. Thank you so much for sticking around with us. This has been Iterator. You can catch us on YouTube or anywhere else that you listen to podcasts. Thanks so much, and we'll see you in the next one. Cheers.